Hey everyone, welcome back to another edition of Super-rime UK with your MJ Group Super-rime valuers, myself, Rob Cohen.
And myself, James Wild.
Here we are again, we're about to hit February. The best thing about January is getting to February. We've got through the month and we're going to do a quick review today, let you know what's been happening, get some good data from James, some good intel, and have a nice review of January 2023 as we hit Feb 2023. James.
Thanks, Rob. So just in terms of data, what we've seen so far in January 23, very positive sale of the week, Rob, just over 16 million over in Ladbroke Square, Notting Hill. So again, like we've been saying so far, Rob, Super-rime in London is still very much that there's positivity there, there's deals still happening as we're seeing and reporting to you. New instructions recovered a little bit this week, 343, whilst the sold figures at 99 there. So an uplift on some of the weeks prior, but still below the averages that we saw in 2022. Quite a few price reductions this week, Rob, 179, so hopefully that opens up and facilitates some of those listed properties to move through to a sale. Just in terms of some other more holistic data, Rob, from some of the property portals, Zoopla has reflected on 2022 and some of that final quarter four after obviously Liz Truss saying that the market plummeted in terms of demand by about 50% there from October to the end of December, whilst many buyers out there on the online property portals seeking out flats and smaller houses to probably keep down their mortgage costs. Buyer demand in January so far this year are also down around 23% in terms of the traffic they're seeing in terms of their 5-year average. And just the stagnant last 3 months of 2022, reducing property price growth to about 6.5% for 2022 there. So Rob, a month into 2023, what are we seeing on the ground so far?
Speaking to a lot of agents, and they are seeing a lot of valuations, a lot of instructions coming on. So I believe the tone has been set for, I would say actually a stronger performing first quarter than many would have expected. There's a degree of positive sentiment out there, and that may not be demonstrated or highlighted so much in all of the headline data that we're seeing and hearing. It's just a feel I get from speaking to our clients, the banks, lenders, and agents, that there is activity, and as the year progresses, hopefully that sentiment will strengthen, even if it is very cautious at present and built on a lot of uncertainty. So I would say sentiment would supersede the headline data currently, and that's something that I'm seeing very positively, and I'm getting some good early vibes about the year, even if the challenges we face in the next few quarters will be very difficult and the headline data may not be what people are looking for.
That's it. Obviously, we had mortgage approvals at record lows last month, Rob, as well there. Obviously, there's a real lag on that data, but in terms of what's being reported, that's at the top of the headlines at the moment.
Yeah, and in terms of super-prime deals, that's the area where loads of questions are being asked of us from our client perspective and banking and lending perspective. And that's the real interesting space. There is good activity there. I think one of the trends for 2023 is the off-market cash buyers in the prime, super-prime, super-prime space, because maybe it's not so attractive to borrow at 4, 5, 6%. Thus, a lot of the deals that are taking place are cash deals, and those people will sit and wait, and then maybe further down the line, when the interest rates are more competitive, they'll come back into the mortgage market. So a lot of those deals are not being seen by the private banks or the mainstream lenders, but there is still activity at those levels out there, and that's what we're seeing in the work that we're carrying out currently.
Yeah, and how's about stock levels at the moment, Rob, just in terms of sales and also lettings perspective?
I'd say from a sales perspective, people are very savvy, and once they realise that they're not going to get a certain vigor, that they just hold, go into a holding position and don't bring a property to the market. Generally, most people in prime, super prime, wouldn't be in distressed positions or be distressed sellers. Thus, they would just hold off and put it in the market. So that manages the supply position, because there's never a huge amount coming on stream. The lettings market is slightly different. That's quite buoyant, and there's quite a lot of properties in that space that are either looking to be rented out or being sold off. And again, with pressure coming on rental prices and haven't seen rental increases across the board, that makes it a more competitive space. So I think that's the one to watch for this year. I think you could see a lot of buy-to-letters go to the market and hopefully from their perspective relinquish some gains.
Yeah, rental growth over the past 6 to 9 months, I think, has been pretty high, Rob, almost sort of double digit across a lot of markets, whether it be that sort of entry level pricing up to £2 or £3 million homes. The rental prices have definitely increased there. I think there's a slight stock shortage, as you were saying, definitely. I think there's, in terms of the rental market, I think there's the rise of the sort of turnkey property with a lot of build-to-rent flats coming online now. People taking those properties, maybe paying a slight premium for that sort of turnkey element there. But that's sort of a new facet to the lettings market, I would say. Just moving across to commercial high street retail, Rob. Cineworld is in administration at the moment, sort of creditors contacting some of their rivals to try and, as a sort of survival bid for them. Any sale would include Cineworld and the Picture House chain. So a bit of negative news there from the sort of a lot of Cineworld premises operate out of town retail parks and premises. On a more positive note, Rob, M&S, the share price up around 45% since October, seeing a recovery after M&S shares. They almost halved in value in 2022, having a real dip against the negative sort of market backdrop there. So some positivity, a real recovery there from one of the long-term high street players.
I have to tell you, retail sentiment, believe it or not, it goes against the grain in terms of everything we're told in relation to inflation and increasing prices and cost of living. But retail sentiment, maybe in more high-end products or restaurants, are actually performing much better than expected. So to a degree, there's a sentiment out there. It might not come across on the data or the headlines or the numbers that we're being told, but what I'm feeling on the street and speaking to our customers and clients, there's a more positive sentiment than expected. And in the UK, we're very sentiment driven with our economy. I think that's just something to think about as first Q1 and Q2 of 2023 happen.
Yeah, in terms of sort of flagship stores, sort of marquee stores, and prime retail spots, a lot of those have become available in the last couple of years, Rob. So I think maybe some retailers taking a more long-term view, possibly as well, and looking to secure those flagship premises. We've seen it particularly in Regent Street, Oxford Street, over the course of the last 18 months or so. Just in terms of the mortgage market, Rob, we've seen a lot of lenders the last week or two reducing rates around anything from about 0.1 to 0.2% across their product ranges there. So a bit of positivity there in terms of for the domestic mortgage market. Can give you a couple of examples there. Santander and Barclays, they've slashed their rates, as they've said, but they're at the higher end of 0.2% across its product ranges. Again, Barclays there, it's now offering a 5-year fixed rate deal for borrowers, 25% deposit, 4.41%. So that is a 0.27% decrease. So a few more deals out there, Rob. We've obviously got the Monetary Policy Committee meeting in a day or so, 2nd of February, whereby they'll be deciding on what to do with interest rates. Are they going to stay the same? We're going to go up an increment of 0.25 or even 0.5%. Some people in the market saying we're going to go up another 0.5% to 4% on the base rate. I'm not sure if they'll just scale that back a fraction this time, Rob. Any thoughts on that?
Quarter of a point, half a point. Feel it's built in, and the markets are expecting something within that range.
Great. And just a final note on house builders. They've reduced their forecast for this year in terms of the delivery of new homes. Persimmon, Barratt and Taylor Wimpey have just warning of a marked slowdown in the UK housing market. Obviously, those three, some of the main three volume house builders which operate nationwide and don't have quite such a London focus, but Barratt Homes anticipates delivering around 16,000 homes in the year up to the 30th of June. This is going to be down from about 18,000 the previous year, so a drop off there in terms of their delivery of housing. It comes at a point where we're already well below our housing delivery targets, Rob, so I feel that those statistics are going to worsen possibly over the next year, and we're going to have to build on that in 2024 onwards.
House builders, they're notorious for managing downturns in this way. They will land bank, they will hold out, wait for them to get the best pricing possible for their product. And so it's no surprise that in 2023 they will pull back and wait for conditions to improve so they can maximise their development schemes. And that's how generally they perform in any downturns and cycles. So land banking, holding back, waiting for better markets. And I think 2023, that will be a similar trend that you'll see across all of the major developers in the UK.
Thanks, Rob.
Brilliant, James. Great to be back with you. We will see you all next week. Stay positive, 2023. Good sentiment out there. Hopefully it's being spread to all of you. And we will be back with you next week. Thank you, everyone.
Thanks, Rob. Thanks very much, everyone.